SoFi Technologies Inc. is currently trading at $22.98 USD, marking a sharp intraday decline of 1.38 points or 5.67% as of late morning on Friday, January 30th, 2026. This sudden move downward is catching many investors off guard, especially considering the company just reported its first ever $1 billion revenue quarter earlier today. The market often operates on a different set of rules than basic logic, and right now we are seeing a classic example of sell the news behavior playing out in real time. While the headline numbers look fantastic on paper, record member growth and a beat on the bottom line, the reality of the stock price is telling a story of high expectations that had already been priced in over the last few weeks. When a stock like SoFi or even Nvidia stock runs up in anticipation of a big announcement, anything less than a perfect forward outlook can trigger a massive pullback. What most people are missing right now isn't the current price drop, but the underlying shift in how SoFi is making its profit. While the general crowd is focused on the lending side of things and how interest rates are affecting personal loans, the real story is in the fee-based revenue, which just surged over 50%. This creates a curiosity loop for the smart investor. Why is the stock falling if the business model is becoming more stable and less reliant on the whims of the Federal Reserve? It's because the market is currently questioning the 2026 guidance. Management expects GAAP EPS of about 60 cents USD for the full year, which is technically above consensus, but certain institutional players are worried about the heavy spending required to scale new products like their stablecoin and international payment systems. This tension between a stellar past quarter and a cautious future is exactly what's driving the volatility we see on our screens right now. You might hear the usual chatter on social media or around the water cooler that SoFi is just another meme stock or a risky fintech play that can't compete with the big banks. The common ground most investors share is the belief that SoFi needs to be the Amazon of finance to justify its valuation. But if we look closer, the reality challenges that simple narrative. SoFi isn't just trying to be a digital bank, it's becoming a tech infrastructure provider. However, the contrarian view here is that by trying to do everything, from student loans and credit cards to crypto and insurance, they risk spreading themselves too thin. Unlike a focused individual brokerage like Interactive Brokers that dominates a specific niche of professional traders, SoFi is fighting a war on 10 different fronts. This aggressive expansion is expensive, and today's price action shows that the market is starting to demand more efficiency and higher margins, not just more members. The sheer volume of trading today is significant, with over 68 million shares changing hands before the lunch hour. This level of activity suggests that it's not just retail traders on the Robinhood app making moves. Institutional blocks are being repositioned. When we look at the broader sector, companies like Fidelity or Schwab Intelligent Portfolios are seeing more stable flows, but SoFi thrives on this high beta energy. The recent stock movement has been a wild ride, with the price hitting a 52-week high of $32.73 before this recent slide back toward the low 20s. If you've been looking for investment help, you know that timing these entries is incredibly difficult. The stock is currently trading below its 20-day moving average, which often signals a bearish trend in the short term, regardless of how good the earnings call sounded. If we look at the technicals, the support level around $22.50 is going to be the line in the sand for the rest of the day. If it breaks that, we could see a deeper slide toward the $20 psychological floor. On the flip side, if buyers step in to buy the dip, we could see a recovery toward the $24 range by the closing bell. This is the kind of environment where online investing becomes a game of nerves. Whether you're using the SoFi trading platform platform or checking your balance on the Fidelity mobile app, the data is the same. The market is currently repricing the risk of SoFi's aggressive 2026 roadmap. Comment below how many shares of SoFi you currently hold and what your average cost basis is. I'm curious to see who's still holding through this volatility and who decided to take profits at the peak. Now, let's talk about what this company actually does for those who might be new to the ticker. SoFi started as a student loan refinancing shop, but they have transformed into a full-service financial platform. They have their own bank charter, which is a massive advantage over other fintechs because it allows them to hold deposits and use that cheap capital to fund their loans. This is why you see such high growth in their SoFi Money accounts. They also own Galileo, a technology platform that powers many other fintech companies, and Technesis, a cloud-native core banking provider. When you use various investing sites or even some features on the SoFi Robo-Advisor, you're often interacting with their back-end tech. Their business model is built on a flywheel effect. Get a member in for a high-yield savings account, then sell them a credit card, then get them to use the SoFi Invest features for online investment. In the past, SoFi relied heavily on the lending segment, but this morning's report showed that financial services and their tech platform now make up more than half of their total revenue. This is a massive shift, which should, in theory, lead to a higher valuation multiple over time. But the reality of 2026 is that the lending environment is still tricky. With Treasury yields moving around, the demand for personal loans can fluctuate wildly. Even though home loan originations nearly doubled year over year, the cost of acquiring those customers remains a point of contention for analysts at places like Bank of America, who have been skeptical of the stock's recent run. They recently resumed coverage with an underperform rating, suggesting the company might need more capital to sustain this pace, which often scares off people looking to invest online. Looking ahead, the catalysts for the rest of the year are going to be centered on their SoFi Pay expansion and their blockchain-based international remittances. They are the first national bank to issue their own stablecoin, SoFi USD, on a public blockchain. This is a bold move that puts them ahead of traditional firms like Fidelity Investments or the standard Fidelity ETFs in terms of pure tech adoption. If this pays off, it could fundamentally change how peer-to-peer payments work. However, the risk is regulatory. The government is still figuring out how to handle banks that are deep into the crypto space. One wrong move from a regulator could wipe out the gains from these new segments overnight. This is why the expectation of being a tech leader is clashing with the reality of being a regulated bank. Comparing SoFi to its peers gives us more context. While Robinhood Trading App and the Robinhood app have captured the retail trading crowd, SoFi is trying to capture the entire wallet of the consumer. They want your paycheck, your mortgage, and your retirement account through SoFi Active Investing. In contrast, something like Schwab Intelligent Portfolios or Fidelity Wealth Management focuses on a more mature, asset-heavy demographic. SoFi is betting that their younger, tech-savvy member base will grow into those high-net-worth individuals over the next decade. It's a long-term play, but the market today is focusing on the next 3 to 6 months. If the 2026 EBITDA guidance proves to be too optimistic, the stock could stay stuck in this $20 to $25 range for a long time, frustrating those who jumped in during the hype. Institutional activity is another area to watch. We've seen unusual options flow recently, with a lot of tactical positioning rather than outright bearishness. This means the big players aren't necessarily betting on the company failing, they are just hedging their bets because they know how volatile these earnings days can be. If you're self-investing, it's easy to get caught up in the 5 daily swings, but the institutions look at things like tangible book value, which for SoFi just jumped to over $7 per share. That's a 57% increase year over year. That kind of growth in real value is hard to ignore, even if the price-to-earnings ratio looks high compared to a traditional bank like JP Morgan or even a digital-heavy firm like SoFi's competitors. The future outlook for SoFi is a balance of high-speed growth and the gravity of being a financial institution. The upside is clear. If they continue to add 1 million members a quarter and keep their cross-buy rate at 40%, they will eventually become a dominant force in the industry. The downside is equally clear. Any spike in loan defaults or a slowdown in consumer spending would hit their lending business hard, which is still a major part of their profit. The reality of today's 5.67% drop is a reminder that the market is a weighing machine in the long run, but a voting machine in the short run. Right now, the voters are nervous about the macro environment and are taking some chips off the table after a record-breaking report. To wrap this up, SoFi is currently at a crossroads. We started the day with the expectation of a massive breakout based on $1 billion in revenue, but the reality delivered a sharp correction as the market digested the costs of that growth. We've seen how the business model is shifting towards a tech-first approach, and we've analyzed how that compares to more traditional or niche players like Interactive Brokers or Fidelity Brokerage. The central insight remains: SoFi is no longer just a prominent